The market did nothing, but your options value changed. What's going on? So you have bought an option, and the next day when you check in to see how your position is doing, you see you have lost money. Perhaps you're feeling particularly frustrated because after a long weekend, the loss seems unusually large and you just don't get why. Welcome to the fourth video in the series where I try and explain options using everyday concepts hopefully everyone can understand. It can take a while to get your head around options, but once you have it, the additional know how will always benefit any kind of trading you do in markets, or even if you just engage with financial markets in more general ways, but on a regular basis. In my first video, I compared owning an option to being like owning an insurance policy. Naturally, it follows that owning an insurance policy for many months means you pay a premium for every one of those months. That is, the longer you want the insurance cover, the more you have to pay. Similarly, all else being equal, buying a 6 month option costs more than a 5 month option. A 5 month option will be more expensive than a 4 month, etc. All the way down to a 2 day option being more expensive than a 1 day option. Of course, while the market is open for trading, it will constantly adjust for small changes in value. After it closes, though, say on a Friday and then opens up again on a Monday morning, that 2.5 day reduction in the value of the option is seen all at once. The change is less pronounced going from late afternoon to the next morning during the week. That is because this time frame is less than a 1 day change in value, and the market will generally adjust for the balance during the day. Further, the change in value is typically larger when passing over a long weekend. This change in value of an option due to the passing of time is called theta. There can be a fair number of inputs that go into what you could be expected to pay from one business day to the next. As already mentioned, moving forward 1 day, a weekend, a long weekend, or a public holiday should all have different expectations. Further, moving over events should also have a material impact on expectations. For example, you have events that are key to individual stocks like the financial results of a company, or say Tesla announcing their quarterly vehicle delivery numbers. Tesla stock often has a large move after the announcements. You also have events that have global impacts, and hence most option markets will price it in, increasing the options premium while the event falls during the life of the option and decreasing it when the event has passed. Typical examples of these are when the Federal Reserve or the European Central Bank announces monetary policy changes. Generally, economic data being published has an impact, but to varying degrees, as some data are more important than others. When buying, professional investors will generally put a lot of thinking into picking the expiry dates of their options such that it falls after major events to maximize the value or before weekends to minimize unnecessary theta paid. When selling, they try and do the opposite, of course. All of this will have a bigger impact for options that are closer to expiry, say maybe a few weeks or a couple of months, compared to options that are maybe 6 months or a year away from expiring. Hence, your daily theta typically increases as the option gets closer to expiry. Again, for professional or institutional investors, a lot of thinking goes into what they are expected to pay. And I don't think anyone gets it completely right simply because what you are expected to pay is an attempt to look into the future and inherently has uncertainty to it. In a theoretical sense, it is, of course, easy. However, the real world always has the potential for curveballs, which goes to the very core of what options tries to do. Like insurance, you are at least partially trying to price or value the unknown. Like car insurance, if you knew the car was going to be in an accident on a specific day, just don't drive it that day or sell it the day before. In both cases, you don't need the insurance at all. An astute option trader thinks about the possible and probable outcomes when deciding to buy or sell an option strategy. There is a difference between the possible and probable. Lastly, by the time your option expires, you have, of course, paid 100% of the premium of the option if you owned it. If you sold the option, you have earned 100% of the premium. The option is then either out of the money and worthless or in the money and worth however much the market moved through the option strike. For strategy, each individual option can be valued separately and it all simply added up. So why even consider theta when you are anyway going to pay or earn the full option premium by the expiry date? Because most options are never exercised. They're often taken profit on or stopped out of during its life. More on that in a future video. Let's wrap it up there for today. Today we only talked about theta. A lot can be said on this topic and even more on how it is calculated. Knowing that it's there and why it can be a lot sometimes and not that much on other occasions is really the most important part. Thanks for watching. If you liked the video, please give it a like and consider subscribing. It really helps the channel. Also, let me know what you think in the comments below.